Good afternoon, everyone. Thank you so much for being here today. I'm excited, really excited to be here. This is my first physical event in 18 months. So if I forget my words, if I don't know where I am, or if I forget how to do the clicker, please bear with me. Just a bit of self-introduction, and thank you, Christina, for the kind introduction. I run the advocacy team in Asia Pacific for CFA Institute, and as part of my remit, I have oversight for something called capital markets policy, as well as Asia Pacific Research Exchange. And as Christina was alluding to, ARX is a great resource. Would love to have you go on the website and look at some of the webinars that we've been doing in the last 18 months. Today, this is what we're going to cover. I have the pleasure of sharing some of the insights from our award-winning report on climate change analysis in the investment process. It was published late last year, and and as I said, this report actually won an award in Europe. And then we're going to have a quick look at some of the sustainability reporting frameworks that are increasingly important for both investors and for issuers in framing the conversation around climate change. And then, if we have time, we'll look at global ESG regulations. So, in terms of the report, why did we start on the project? We believe at CFA Institute that climate change presents a significant challenge to global markets and economies. And they will, and I hope you agree with me, that climate change is posing additional costs and risks to all parts of society. And I'm not sure anyone can escape. And in relation to that, finance has a key role to play. And that was a driver for CFA Institute to start on this project. And in particular, we want to focus on what we can do as a profession in the role in terms of allocating capital more efficiently and more effectively to mitigate climate change. The report is titled Climate Change Analysis in the Investment Process, and what we aim to achieve is to improve knowledge and understanding on how climate risk can be applied to financial analysis and portfolio management. If you scan the QR code, you can download the report for free. And through the study and through sessions like this, we hope to inform practitioners the considerations and key drivers in climate change analysis, what are best practices out there, and what are some of the resources that may be available to investors. Here's the section outline for the report. I'm going to cover a little bit of everything today, with the exception of scenario analysis and case studies. You may think that, well, actually those are the most interesting parts. Well, if I cover everything, then you won't have an incentive to look at the report. And besides, for case studies, we have an amazing one from NZSuper that Lucas will be talking about. A primer on climate change, and it's all about greenhouse gases, or GHGs. Greenhouse gases trap heat in the atmosphere. And the more greenhouse gases are put into the atmosphere, the more heat they trap. Now, since the Industrial Revolution, humanity, like us and our ancestors, have been pouring vast amounts of GHG into the atmosphere. And up to a point, our trees, our forests, our oceans were able to absorb those greenhouse gases, but no longer. And I think a lot of evidence is suggesting that we are way past that point. And the increase in atmospheric temperature is contributing to a host of problems, such as extreme weather events, famines and droughts, and which in turn will lead to more property damage and dislocation of communities than any of us have seen in our lifetimes. Now, we probably don't know when these events will arrive, but we're pretty confident that they will. And the issue is going to affect every company and every investor on Earth. And that's a compelling reason why investment professionals need to incorporate these new realities into our analysis. Because when we make an investment decision, we need to know that we're making the right ones in a world where the effects of climate change are increasing. This is a slide of a quote from Jeremy Wentham. He's a British investor. He was one of the co-founders of GMO, an investment manager. And this quote says, "Capitalism has a severe problem with the very long term because of the tyranny of the discount rate." anything that happens to a company that is like 25 years out doesn't really matter. Therefore, in that logic, grandchildren have no value. And I think what he's trying to illustrate is that when assessing the value destruction that climate change will bring, we cannot be too short-sighted. If we think about the economic pain that will happen as a result of climate change, it's probably going to happen sometime down the line. But the consequences of inaction may not show up for until many years away, and therefore it's human nature, right? Inertia kicks in, there's a temptation to delay acting. And so, but at the same time, greenhouse gases such as carbon dioxide actually stay in the atmosphere for decades. So inaction today causes a bigger problem tomorrow. And that makes the task of avoiding the worst effects even harder and more challenging. So what we're trying to say is that some things don't show up on discounted cash flow models, even though maybe they should. A note on some of the physical and transition risks that climate change may bring. So climate change risks are usually divided into these two categories. In terms of physical risks, the panel on the left, many of us have heard of or suffered from some of these already. I mean, and if you have friends in North America, they would have told you this week that they had a massive heat wave. And in addition to that, we are seeing increased incidences of things like hurricanes, typhoons, floods, and forest fires. And these physical changes will affect every company to a degree. And we need to, as investors, we need to be able to identify and evaluate the impact of these physical risks as associated with climate change. Now, what about transition risk? The world economy will transition to a much less carbon-intensive one over time. But the question remains at what speed and what will happen, and how will the transition be funded, right? And who will be, which company will be the winner and which one will be the loser. So as investors, our job is to educate ourselves on the transition plans of major economies around the world, and what it means to some of the sectors and companies that we're investing in. So as an example, there's one estimate that says that electric cars will make up 50% of the global fleet by 2035. And if that's correct, there will be massive disruption, not only to the automotive sector, but also to things like oil and gas and energy production industries. So which side of the risk do we want to be on? Now, all industries will probably undergo some form of transition to a lower carbon world. They may be doing it at various speeds, some fast, some slow, and it will probably be a function of government policies, consumer preferences, as well as the companies themselves. And again, for savvy investors like the CFAs, we can actually take this as a huge opportunity. A note on carbon markets. We believe the most effective tool in combating climate change is a price on carbon. By putting a price on carbon emissions, we can kind of use the invisible hand of the market to create an incentive and motivate economies away from burning fossil fuels. Now, currently, carbon pricing follows two main methods: a cap and trade system and a carbon tax. And I know that in New Zealand you have an emissions system, which is very similar to a cap and trade system. So a cap and trade system sets a carbon budget for a market, and permits or credits are sold to users. So companies, if they want to emit carbon dioxide or whatever greenhouse gases it is that they need to emit as part of their operations, they have to buy these permits about the level established by the cap. And so these permits are traded on the secondary market. And the idea is that over time, companies will be incentivized to lower their costs and to lower costs by lowering emissions. So that's the cap and trade system. Under a carbon tax, a fee is placed on carbon generating activities so that both industries and consumers are incentivized, again, to substitute cleaner energy alternatives for fossil fuels. And as an example, if you have a tank that you have a petrol tank you have to fill up for your car, you may want to move to a hybrid or electric vehicle. But the issue with the carbon taxes, and as with all taxes, finding the right level is key, because you don't want it to be regressive. If it's set too high, it damages the economy, but setting it too low will not bring about the desired behavioral change. Now, we believe, as I said, carbon markets will be a great solution in terms of a market-based solution and a key step in combating climate change and decreasing emissions. But it's not the silver bullet. It's not the only thing. It's not the one thing that will help reverse the decades of CO2 or other gases that have been put into the atmosphere. But this is a start. As part of our project, we actually did a global survey last year and to gauge where the industry was when it comes to climate risk integration. And we had just under 3,000 responses globally. And on a macro level, when asked whether it is important to have a view on climate change in order to effectively manage investments, 76% of respondents said it was important or very important, 76%, okay, let's see there. But on the left-hand side, then we asked whether respondents currently incorporate climate risks into their portfolios, and this is on the left-hand side. And globally, 40% of respondents said yes, so that's the green bar on the left. Okay, now 76% said important or very important, but only 40% are doing so. And when we break it out into the 3 regions of Asia Pacific, Americas, and Europe, Middle East, and Africa, EMEA, APAC is the purplish blue bar, the third from the left. APAC had the highest percentage that said no. Okay? And the other question we asked was whether respondents saw much demand for portfolios that would lead to a lower carbon intensity, and that's the chart on the right. Globally, about 2/3 of all respondents said no, there was no demand. Okay? And again, the demand was lowest in Asia Pacific. So what can we infer? Well, we can say that actually clients don't want it, and therefore we don't need to do anything. Right? I hope that's not the conclusion that you draw from this survey results. But rather, managers elsewhere are actually building up their suites of capabilities, the solutions and track records, and we can't afford to fall behind. And my influence would be that it is in our duty to be leading the conversation, to be educating clients, and be in a position to show them the way. So what can we do? If we're not waiting and being passive, what can we do? I think there are a few things that we can do. And so to end on a constructive note, in our report we talk about investors getting up to speed with market and economic implications of climate change and how that may be impacting on our investments. Even if you may not believe climate change is real, the policy responses to climate change are real. So have you started modeling them? The other thing is about factoring expected carbon pricing into financial analysis. I think that's carbon price. There will be a carbon price, and I think as I said, there's a scheme in New Zealand. China has just pioneered one this year, and I think increasingly we're going to have to be hearing about conversations of a cross-border carbon tax. The other thing that I think we can do is getting a better understanding into the expected intensity or frequency of physical and transition risk when possible. I know there's a part in Lucas's presentation about engagement. To us, engagement is key as an active, responsible investor. And the engagement can be at different levels. One level is on the availability of information. We want to know, we want to be part of the conversation that shape what issuers, what companies are disclosing. So we need to, again, our responsibility is to let regulators and companies know what climate-related information might be useful. And the other level is at the stewardship level. How are we managing our portfolio companies? How are we engaging with companies to understand what they may or may not be doing with regard to climate? Are they mitigating the risk? Are they taking advantage of some of the opportunities? And in the report, as I said, we have a number of case studies. They were contributed by asset managers from across the world, and they cover a wide range of topics, geographies, asset classes, from developed to developing markets, equities to fixed income to carbon asset classes, general and macro, and we're also adding to these case studies all the time, so please check it out. So that's kind of a very quick overview of the report. But I also want to spend some time on data availability. When we talk about ESG or sustainability investing, a lot of the time I've heard, and people have also, I think around the world, have been talking about data availability as a key constraint when it comes to doing ESG integration or when it comes to climate integration. I mean, the data have gotten a lot better, but I think we probably can all agree that there are still quite a few challenges. And issuers are under increasing burden to provide timely, consistent, relevant, decision-useful information. And it is also important for us as investors and maybe as disclosers, some of these issuer disclosure frameworks. So today I'm going to have a quick look at the SASB framework and the TCFD framework. These two frameworks are probably the two that the investment community is coalescing around when it comes to climate. So first I have the SASB materiality map, and SASB stands for Sustainability Accounting Standards. It's actually now got a new name. It's just merged with IRC, and the whole thing is now called the Value Reporting Framework. And SASB focuses exclusively on the materiality of ESG information, including climate-related data. And it's a great research tool for investors because it really focuses on materiality and it has investors in mind in terms of audience. So it helps investors filter out the noise and or the data that are not material or relevant. And this chart shows the SASB materiality map for about 10 different industries. They're shown across the top, and they range from consumption, financials, healthcare, to infrastructure and resources. And down the left-hand column, there are lists of issues. And on this slide, we can see environmental issues, social capital, human capital, and business model and nomination and leadership and governance. And the heat map shows how material these issues are for companies in different industries. So if you see a red box, those are issues that are likely to be material for 50% or for over 50% of that industry. If they're orange, it's less than 50, and if they're white, they're not likely to be material. So let's go back to the last slide and look at the first issue under environmental, which is greenhouse gas emissions. Now it's red for non-renewable resources and transportation, i.e. they are very likely, so greenhouse gas emissions are very likely to be material for non-renewable resources and transportation. And they're white for financials and healthcare. So intuitively, I think it makes sense. And it focuses on, so the SASB framework focuses on what's generally agreed upon as material in a given industry. And it's a great starting point, right? You can always go beyond what the SASB framework recommends if you believe there are more material factors. And when it comes to climate, the SASB standard also treats climate data differently depending on the industry. So if in oil and gas industry, the climate data categories that are most useful to investors are different to the ones in the financial services industry. So in oil and gas, investors may be more focused on emissions, whereas in banking, they'll be more focused on the bank's loan book, the financing of greenhouse gas emitting projects. And quickly on TCFD, I think this is these four letters are something that we're all very familiar with, the Task Force on Climate-Related Financial Disclosures. And they provide recommendations that companies, on company disclosure into 4 areas. On this slide, I have governance and strategy. On the next slide, risk management and metrics. And the objective is really for investors to be better informed about climate-related risks and opportunities for companies in their portfolios, and for basically for them to understand better the linkage between non-financial information and financial information of a company. I know that New Zealand is talking about requesting mandatory TCFD disclosures for all companies. Australia has also encouraged listed companies to adopt TCFD. So I think globally and in the region, we are seeing many governments and regulators adopting TCFD as a top-down policy direction. And the UK is doing the same, so large companies and financial institutions in the UK have to provide TCFD disclosures by 2025. And I think what's also interesting is that investors are now, or asset managers, instead of just being consumers of TCFD disclosures, i.e. they look at a company's TCFD disclosure, I think there's more and more request on investment managers to be a disclosure as well. So they are investment managers, so we can see the shift of institutional investors being consumer of information to being disclosures to help structure a climate strategy around the way they manage people's money. Okay, now that brings me to the, how am I doing on time? Okay, okay, I know that many people will roll their eyes when they hear the word regulation and policies. I'm not one of them, I love them. And I know that if I talk about, if I tell you that according to PRI, there are about 650 policy tools or standards around ESG regulations globally, you'll probably want to kill me. And I think I can almost, when 600, and not only that there's 650, right, but it's actually the numbers accelerating. And I can almost hear collective groan. But what if this means a trip to Europe? So, in terms of ESG regulations, the most eye-catching, spectacular, jaw-dropping regulations are coming out of the EU. So, and this followed the EU's Sustainable Finance Action Plan, which has this three broad objectives, including to redirect capital flow into a more sustainable investment. And I think the estimates is that they're going to spend €1 trillion into doing that to build a more circular economy. And if you look at the schematic on the right, it shows EU's approach to a circular economy. And what they're trying to do is to make sure that there's a greater consideration of investors' sustainability preferences and make sure that there's less economic harm caused by weather-related damage. So this is a very top-down policy goal in the EU. And in terms of ESG regulation, this is a simplified view. I mean, there's much more out in the EU, and there's much more coming down the line. But I wanted to touch on 3 pieces of regulation today. And they are the Taxonomy regulation, the Non-Financial Reporting Directive, which is called NFRD. It mandates public ESG-related disclosure for companies. And then at the bottom, the Sustainable Finance Disclosure Regulation, SFDR. So all these alphabets, I don't know if we'll ever run out of alphabets. But the SFDR is probably the most relevant and most impactful to the asset management and financial services industry. In terms of the taxonomy, the EU taxonomy regulation is a flagship project, and it establishes a EU-wide classification system or framework so that there's a common language on what's sustainable and what's not. And it's kind of like the ultimate dictionary or catalog. So if an activity is in there, you are in business. So on the slide, I show the 6 EU environmental objectives. We'll go back to those. And there's also a definition of what a sustainable investment means in the EU. Now, about 3 months ago, in April, the European Commission delivered a package of measures which provided further substance to some of these regulations, right? And I'm going to call it the April package, and I'll be referring to the April package in the next few slides. So in the April package, basically you can see all the 6 headings, right? But there's actually, until the April package came, there's nothing really underneath these headlines. So nobody really know or can determine what's a sustainable activity under these headlines. But the Delegated Act that was published in the April package put quite a bit of meat on the bone in terms of the first 2 objectives, the climate change mitigation and climate change adaptation. Now, and the rest will follow next year and the years after. Now, the EU taxonomy has taken 3 years, and it's actually generated huge, intense debate within the EU, because whether a sector is green or sustainable is actually not that straightforward. And it depends on how reliant a country is on it. So sectors like gas and nuclear are very, very contentious. Especially like there are some countries in the EU who are very coal-reliant, and they want to use gas as a transition away from coal, right? So they're lobbying for gas to be included. And some are also quite reliant on nuclear energy, and they think that nuclear should be part of the taxonomy. And there's also a lot of people who say, no, nuclear should be excluded. So how did they resolve this? Well, in the April package, for the time being, neither gas nor nuclear have been included, and they're going to revisit it and decide later on. So we can imagine that there's a lot of discussion going on. But that said, with the delegated act that was published in April, the taxonomy is said to cover 40% of all listed companies in the EU, which in turn are responsible for 80% of all direct greenhouse emissions in Europe. So this is a big deal. Okay. And so this is a taxonomy, right? So it defines everything. And then next we have issuer disclosures. We talked about NFRD, which requires companies, issuers to provide disclosures such as environmental protection, social responsibility, anti-corruption, and board diversity. Now, in the April package, there was a proposal to replace the NFRD with something called the Corporate Sustainability Reporting Directive, or CSRD. And there are new requirements under the CSRD, so additional requirements over and on top of NFRD. They would include things like double materiality, right? Delicious term. How a company determines what's material, setting sustainability targets, and information on a company's value chain, including its supply chain, business relationships, products and services. Okay, and in terms of coverage, the NFRD probably applied to about 11,000 companies. Under the CSRD, the net is going to be much wider, and it's estimated that they will catch about 50,000 companies in the EU. So how does the issuer disclosures piece interact with the taxonomy? Well, firms that are subject to the NFRD will have to provide information on the proportion of their activities that are classified as sustainable in accordance with the taxonomy. So then basically what consumers of this information can tell is the proportion of revenue of a company that is taxonomy aligned, that's sustainable. Okay, so that's how the taxonomy will align with the issuer disclosures, the CSRD. And then we have the SFDR, which is, as I said, applies to both asset managers and financial services advisors. And it's probably going to be quite difficult. I think it's a very complicated piece of legislation. It requires disclosures both at the entity level and at the product level. And SFDR kicked in March this year. And at the entity level, managers have to disclose their risk policies, how they consider principal adverse impacts, and their remuneration policy. And these disclosures are to be published on the website and in their pre-contractual disclosures. And then at the product level, the most visible change is that every single product in the EU will now be categorized into one of these three categories. Article 9, dark green, Article 8, light green, and Article 6 is basically everything else. And as you can tell, the dark green ones have the highest kind of obligations or thresholds, so everything needs to be a sustainable investment. So this year, the level 1 kind of disclosures kicked in, so you have to tell people how you do it and what your objectives are. Next year, that's when the fun starts. You have to do periodic assessment. You have to tell people why, how and if your goals were met, and you're supposed to provide like 18 indicators on each fund as to on the principal adverse indicators. So there's going to be an ongoing periodic assessment requirement, and this is quite revolutionary in terms of the disclosures that asset managers have to disclose. But if you think about the value of the flow of information along the investment chain, it kind of hangs all together, right? The taxonomy provides the language, the framework. The NFRD, the issuer disclosures, sets reporting rules for companies and asks companies to disclose the portion of their activities that are sustainable. And then the fund managers will take those information and feed them into the model and decide whether their products are sustainable. So that's how it's kind of how it all should work together. But the intention of all this ultimately is about redirecting private capital back into the economy. So the EU is thinking that by nudging people, asset managers and companies into thinking about sustainability more seriously, that the whole economy will move towards to a lower carbon one. Okay, does anyone want to go to the US? So we can take a quick hop over across the ocean and look at the US. I don't have to spend so much time in the US because there's really nothing there, but it's changing. And I think the new SEC chair, Gary Gensler, has signaled repeatedly that they will be looking very closely on setting a framework for issuer disclosures. And probably we would think that is a no-brainer, but there's actually quite a few challenges within the US about that, and people are accusing the SEC of overreach and threatening to sue. So, sorry, last bit of marketing. This is my last slide. So about 2 years ago, the ECFA Institute started a project on developing a standard for ESG disclosures for investment products. Please don't groan. It's not an issuer disclosure standard. This standard applies to investment products. And our objective is to set up something that's global and voluntary that will allow investors to better compare and identify and select investment products with ESG-related features that will suit their needs. So last year we issued a consultation paper, and we got quite a bit of feedback. And just in May, we published an exposure draft with the standards, and we're in the process of collecting feedback. And the consultation period will finish in mid-July. So please take a look and let us know what you think and how it can help you or how it can be better. The one thing that we're trying to do for these standards is that it will not overlap with any national or regional regulations. It's global, it's voluntary, and most importantly, it applies to any product regardless of the strategy, what sort of product it is, and regardless of where it is, the market, the geography. So I'm going to be available after this for questions, and but with that, I'll hand over to Lucas. Thank you so much for your time.
Thank you. Well, thank you very much, Christina, and thank you, Mary, for a fantastic presentation. As I will be discussing in more detail shortly, like 70% of investors, the New Zealand Super Fund sees climate change as an absolutely critical issue for long-term investors, not just from an ethical perspective, but also from a risk and returns perspective. So it's a real privilege to be able to sponsor this event. We realize, given the global scale of this issue, the impact of our fund to have a significant impact on this issue is limited as we standing alone. So we welcome the work that Mary and the CFI are doing in developing discussion in this field, and we are really keen to work with all of the CFA charter holders and the rest of the finance industry to tackle this issue. Today I'm going to share some things that we're doing in this space to provide some of of how funds can practically shift their portfolios to more climate-friendly investments, so that in the future, more than 40% of funds will be taking action on climate change. So the plan for today, I'm going to do a very brief overview of the New Zealand Super Fund, talk a little bit about our climate change investment strategy, and then really deep dive into 2 aspects of it. I'm planning to take about 20 minutes, hopefully less, and leave plenty of time for questions at the end. So, up on the slide there's a bunch of information about the super fund. I'm not going to talk through all of it, but I guess the key point about the super fund is it's a government fund. It was created to deal with a structural surplus that was generated by a lot of baby boomers being in the workforce and a demographic shift where we were going to have a lot more people in retirement in the future. So going to the next slide, our mandate. So unlike most funds, we don't have a strictly fiduciary duty to our clients. Instead, our duty is embedded in legislation, and so our mandate is to follow best practice in portfolio management to maximize returns without taking undue risk to the fund, and to avoid prejudice to New Zealand's international reputation and how we invest. Our approach to investing, we think in general markets as a whole are broadly efficient. That is to say, there's not a lot of $100 bills lying around in the pavement. So, we start by defining a reference portfolio, and that's a diverse basket of international stocks. And really, that's our default approach to investing. We don't deviate from that approach unless we are confident that we can deliver a better return. But we do think we do have some unique endowments that give us advantages. We have a long and defined horizon. We know what our liquidity profile looks like. We have operational independence from government, and we have sovereign status, which gives us some tax advantages. So turning to our climate change investment strategy, the super funds always had a view that climate change was important to investments, but that sort of view really crystallized around 2015, 2016 as a bunch of reports, and particularly this Mercer report, pointed out that there was a real risk of asset stranding and business threats to business models being presented by climate change. And we kind of supplemented the general research with our own in-house research, where we talked to analysts about how they were taking into account climate change, and we just couldn't get any confidence that anyone was doing any significant work on it. So we decided, look, this looks like an asymmetric bet. If the world thinks that climate change isn't going to happen, and we decide to invest as if it was going to happen, we'll do really well if climate change ends up happening, but because nobody else is thinking it's happening, we're not taking a penalty for investing in this way at the time. So we went away and we designed a climate change investment strategy, and our investment strategy has 4 elements to it. Reduce. Under that pillar, we measure the amount of emissions. We try to measure it for the whole fund. We get most of the way there. Then we set targets to reduce those emissions versus our reference portfolio. And we have a passive investment strategy that we use to do that, which I'll speak about in more detail shortly. We analyze, so this is more of a bottom-up approach. We look at individual investments and look at how climate change will affect their returns, and therefore that has the potential to change our investment decisions. We engage with companies, so as Mary said, we think it's absolutely critical to work with corporations. We know that while we can simply exclude companies that have very high carbon emissions at the moment, at some point, if the world isn't changing, that is going to mean that our portfolio is going to end up very concentrated, and that's going to come with a bunch of costs in terms of subtracting error. We do work with governments and with corporates to prompt climate action. And then finally, search, where we try and find the best of the best in breed kind of companies on climate change and try and invest in them. So turning to our bespoke carbon methodology. So we decided, the first thing we decided to do is we found that once we'd measured our portfolio, actually most of our emissions were actually sitting in the passive part of our portfolio. And that shouldn't really be a huge surprise because, as I say, our default approach to investing is passive. So, you know, the second bit of research we did is we looked at, okay, if we wanted to set a target and reduce that level of emissions relative to the reference portfolio, what impact would that have in terms of the diversification of our portfolio? And what we found is that small, well, actually quite significant reductions could be achieved with very small increases in tracking error. In fact, we thought you could go to 50% with almost no trade-off. I'm not sure if you can read the slide, but basically on the vertical axes, that is hypothetical return or expected return, and on the horizontal axes, it's the percentage reduction in emissions relative to a reference portfolio. So as you can see in the green box, that's basically a flat line that you're giving up no expected returns. In the yellow box there, the line starts to slope down. It's a bit of a judgment call, but you know, I kind of think in that yellow box, you're doing quite a small trade-off. So you are giving up a little bit of diversification benefits, but you are gaining further reduction. So that's sort of from 50% to a 75% reduction against the index portfolio. And then, you know, in the red box, the trade-off becomes quite extreme. So that's, you know, that's sort of why we engage, because if we don't engage, we're going to be pushed to taking significant trade-offs in terms of our tracking error. So in terms of implementing this approach, the way we create our portfolio is we have two targets that we aim for. One is a reduction in fossil fuel reserves, and that was built on the basis that we weren't seeing anyone saying that they were going to discount fossil fuel reserves, but we were seeing scientists saying that we couldn't use all the fossil fuels that had already been discovered. So we thought that's a pretty clear basis for thinking that fossil fuels were being inappropriately valued. So we said, look, we don't want to mess around with this, we're just going to take them out of our portfolio. So any company that has fossil fuels on their balance sheets, fossil fuel reserves on their balance sheets, is removed from our portfolio. That's the first step. The second step is on carbon intensity. We've set a target of reducing carbon intensity versus the benchmark. You know, there we're trying to remove high carbon intensity companies. But we recognize that actually not every high carbon intensity company is going to fail in this new world. There are some products that, you know, are essential and you know, will continue to have a role in society. So the way we kind of dealt with that is we decided that we would first filter into our portfolio any company that was a top quartile performer on well, in this case it was MSCI's ESG, climate change metric. So any top performing company gets into our portfolio, and then we basically make a list, and with the highest carbon intensity company at the top, and we just go down that list and remove companies until we hit our target. So, you know, that leaves us with a few less companies, and then we just scale the portfolio back to its original size. And just in terms of, you know, how this is performed, these numbers are slightly out of date, but we had $14 billion, so this is quite a long time ago actually. In 2017 we had $14 billion in our passive equity portfolio. It was about 40% of our fund. We sold about 300 companies because of these exclusions, and we still managed to hold 6,000 companies, so there wasn't really any harm to our diversification. In terms of returns, we have generated about 52 basis points of excess returns over the last 4 years. So it's been working out. I'm not sure if you could take that as, you know, a long-term indication, but you know, at least it's positive for now.
Excuse me,
yeah.
Just a quick question on that, because it sort of presents as being really clear focus on returns, and like at the outset, like quite a clear opportunity to, you know, get out of assets that were potentially overvalued. Like, how does the fund approach transition, and do you see like a role to help? You know, obviously there are NZX listed entities that have genuine GHG exposures, and they need capital to assist. So just interested in.
Yeah. So this is sort of our hammer approach. It is kind of very rules driven, and it isn't very sophisticated. So on this approach, we do have the ruling in of companies that we think are doing a good job, but we do recognize, look, there are some companies with fossil fuel reserves that are probably playing a role in the transition, but unfortunately we, in order to, it wouldn't be implementable to go through every company that have fossil fuels reserves and decide, okay, are you in or out? So we've kind of drawn a line in the sand there.
Okay. To Tim's point, if you look at the graph you actually brought up there,
yeah.
If everybody took out the high reserves and high emissions in the world, and no one was basically producing oil and gas, then everything else you've got there is done. Because you've got no one going to work, no one moving goods. So the fact that no one else is doing it gives you the chance to do it.
I mean, that's fair. I think if the whole world started to exclude fossil fuels, we might have to change, but I don't think the whole world's there yet. So. I mean, at that point, the valuations would have changed, so then the original part of our thesis would no longer be true. Okay, and so the next bit of our approach is the more precise bottom-up approach, where we do take into account, transition at a much more detailed level, and we do this primarily for our investment, our large-scale investments. So most of our sort of direct investments is, where this approach tends to be focused at the moment. Although the ambition is that we would roll this out across the portfolio. So there are 5 steps to this approach: identify, assess, filter and quantify or qualify, integrate, and own actively. And I'll talk through each of those in a bit more detail. So the first stage is identify. Really, identify is just what any business analyst or investment professional needs to do when they look at an investment. It's really understanding what the core activities of that business are, what the main revenue drivers are, what its operational environment is, and what geographies it's operating in. So it's just understanding the business, but it's the sort of groundwork that we need to do in order to see how climate change will impact it. The next part is, having identified those key drivers, is to assess the impacts of climate change on that business. And so we have a number of factors we ask our investment professionals to assess the business on. Technology, so we're looking at how might technology shift in a way that would either help or harm this business from a climate change perspective. Resource availability, so for a company like Fonterra, will it lose access to the milk that it puts in its boilers? The impact of physical damage, I think that one's pretty self-explanatory, but are the assets in any place where they will be impacted by rising sea levels, increased wind, etc. Policy, so this comes back to carbon taxes, emissions trading schemes, and then just pure regulations preventing certain behaviors. Demand and supply, so how will consumers and customers' demands for these goods change if consumer appetites change or consumers' views to climate change evolve. And then finally, litigation, so what are the risks of this company being sued, perhaps for the previous impacts they've had on the environment. So then step 3 is the filter stage. So really at this stage it's about whether we just qualify the risk and we put it in the IM or the paper, or whether we actually quantify it and put it in the model. So basically, the first step is to decide, okay, is this a substantial risk? If it's not a substantial risk, we will just qualify the risk. And then the second step is, can we quantify this risk? Are there things that we can use to proxy this risk? How is there a way that we can put a number on this risk? If the answer to either of those is no, then we will just list it in the investment proposal. If we can quantify it, though, we will quantify it and it will go into the DCF model for that asset. Okay, so then the 4th step is integrate, and this is with all the things that we can quantify. This is how we put them into the DCF model. Our preference is to adjust cash flows wherever possible. So, if you've got a carbon tax coming in, then we would reduce or increase the cost on the company and reduce the cash flows that way. There might be additional capex needed. There might, on the other hand, if this was a very green product, it might be able to achieve a premium and therefore get additional revenue. Where that isn't possible, we could adjust the terminal value. So, look at the out of period valuation of the company. And then finally, and this is our least preferred approach, is we would adjust the discount rate either up or down depending on the climate risk. Throughout that whole process, there's lots of risks to double counting, so we do caution against that, and it's actually critical that if you adjust something in one place, you don't adjust for it again by changing the discount rate, for example. Okay, and then the final one is actually post-purchase of the asset. We have a policy of owning the asset actively. So we've identified a list of risks, and we will try and identify mitigations alongside that, and then we'll check in with the asset over time to make sure that they are acting to tackle this. One other thing on this is that the fund has a internal set of climate change scenarios. They are proprietary, so I can't tell you what they are, but they cover types of assumptions like carbon price going forward, assumptions about fossil fuel generation, oil price, sea level rise, max wind speed, and rainfall. And that allows our investment professionals to have a piece of information that they can plug into their models without having to go back and do deep level of research, or we kind of have received views on these things. We still encourage analysts to go further, particularly when the impact is critical to the valuation model. But at least there's a starter for 10 to minimize workload. So just in summary, the super fund invests for the long term to smooth future spending demands created by an aging population. This allows us to take a very long run approach. We believe that the market wasn't properly pricing climate change risk, and we used two approaches to try and take advantage of this, the bespoke carbon methodology and the climate change valuation framework. So I think that's all I have.